Welcome students. So now in the process of learning about the cost of capital, we will proceed further with the next part, and the next part is again a very interesting aspect of the cost of capital, where with the help of the cost of capital we can determine the optimal capital budget, right? We can determine the optimal capital budget. Optimal capital budget means where the rate of return available from any investment is minimum is equal to the cost of the capital, right? Because we all understand that for project or any investment to be a fruitful investment or maybe a valuable investment, we will have to make the NPV zero, or maybe we have to see that NPV of the project is zero or the expected rate of return is equal to the required rate of return. So since the cost of capital is the required rate of return, right, cost of capital or weighted average cost of capital is the required rate of return. So accordingly we will have to see that from any investment or from any project or from any capital investment, how much is the return available. So that should be minimum equal to the required rate of return. So the cost of capital at which we can have the NPV or maybe the return from the project, which is equal to the say, or you call it as the say required rate of return, which is equal to the zero as compared to the cost of capital. So that investment is optimal investment. So if the cost of capital is more than the expected rate of return, it means that investment is not an optimal investment. So to make the investment or to call any investment as the optimal investment, we will have to equate the expected rate of return, or maybe other way around, the required rate of return with the cost of capital of the project. So because required rate of return is equal to the cost of the capital, so where the say returns available from the project are equal to the cost of the capital, that level of investment is called as the optimal capital budget. So with the help of this structure, we can see here that on this x-axis we are taking the return and cost, and here we are taking this amount in millions of rupees. And we have the two curves here, two lines here. One you call it as the investment opportunity curve, and another one is the marginal cost of capital curve. So initially, the marginal cost of capital is 13.2%. You call it as the weighted average cost of capital, or maybe marginal cost, because it's not a static WACC, it keeps on increasing. So to a certain level, it remains fixed, and after that, it increases. And it happens also that when you make a certain level of investment, so the cost of capital remains constant. But after that, if you increase the level of investment, the cost of capital also increases, because risk involved in that investment also increases. Similarly, it goes with the volume of investment also, as well as the time horizon also. If you make the investment for a foreseeable short period of time, so the required rate of return is lesser, or the cost of capital is lesser, accordingly the required rate of return is also lesser. But if you increase the time horizon, so because of the term structure of interest rates, or maybe the amount of the risk involved in that investment being higher, because you cannot see beyond a level, beyond a period of time. You can see maybe for future 3 years, or maybe the next 5 years, that how the market is going to be there, the product which we are going to manufacture is going to be acceptable in the market, or maybe how the competitors would behave, how the market would behave, how the input conditions would be there, how the other technical and other factors would be there in the market. So you can see that you can extrapolate something about the next say 5 years, that can be a optimum foreseeable period. But if you want to do something beyond that, any forecast beyond 5 years, that becomes a little cumbersome or somewhat difficult, and it may not be possible that as the forecast up to the 5 years is true, it can be true even for the next 10 years also, or for the next 8 years also. So as we move further into the time horizon, or the longer the time period, higher would be the cost of capital, because higher would be the interest rates you have to pay, or maybe the required rate of return expected by the equity shareholders. Capital may come in the form of the equity investment or the debt component. So lenders also start expecting the higher rate of return, because they are going to lend you for the longer duration, and say the shareholders also expect a higher rate of return, because their time period involved is also quite longer. So they can also make estimates up to 3 or 5 years. But if they have to make the investment for the longer duration in any project or in any venture, they would also expect the higher rate of return. So because of that reason, the cost of capital increases and it becomes marginal rather than remaining as a static. In the present case, we have seen that, for example, up to this level of investment, if you talk about this level of investment, so it means up to this level of investment, little more than the 70 million, you can call it as the investment, or you call it as the cost of capital is, say, you can say that, for example, if you draw a line here, so up to this little more than the 70 millions of investment, the cost of capital will remain 13.2%, because this line is going like this is a static. But the moment you increase the investment more than 70 million and it goes up to little less than 90 millions, right? So in that case, the cost of capital will become 14%. And further, if you increase the investment to up to this level, maybe up to 95 millions of the total investment, then it will become 14.6%. So now we will have to see, because the moment you are increasing the investment, cost of capital being marginal, it is also increasing. Marginal cost of capital curve depicts something like that. So what is happening? So the investment opportunity curve and the marginal cost curve are depicting the inverse behavior. Because when you are making the investment, so when you made the first investment in the project A, which is close to somewhere you call it as about 30 millions, little less than 30 millions of Indian rupees, when you made the investment, cost of capital was lesser. But when you wanted to have more money, you wanted to make more investment and go up to the little more than the 70 millions of the investment. So you wanted to make the investment in the project B also, you wanted to take up the project B also. So there the cost of capital up to this extent remaining static, but when you go, means up to A and B, the cost of capital is going to remain as the 13.2%. But when you go for the third investment also, you want to borrow more money from the market and want to make investment in the opportunity C also, or the project C also, cost of capital is going to increase initially up to 14% from 13.2%, and then beyond a certain amount of investment is going to be 14.6%. So while looking at or how to determine the optimal capital budget, we will have to see on the two things. On the opportunity, say investment opportunity curve, where you call it as the rate of return is going down. Right? This is a return also. This is depicting the cost also. This is depicting the return also. So cost and return both. So the rate of return is going to go down. Initially, for example, the project A was giving us 18%. Then the project B started giving us little less than 17%. It's significantly more than 16%, but less than 17%. And when you go for the project C, making the investment for the project C, it is again further going down. The rate of return is further going down, and it is somewhere between 15 and 16%. So up to C. So what is happening when you are increasing the investment from the one level to the next level and from next level to the next level? So the rate of return is going down, because all the projects are not giving you the same rate of return. Otherwise, you would be indifferent. So you have to choose them one after the another. And for example, all these three projects are independent, and you have the borrowing capacity also, and you can make investment from your internal sources as well. In that case, you have to look for that up to what extent I can make the investment, because it's not the question of making the investment. At the same time, you have to see the cost of capital also. It's the internal cost of capital also. It is the external cost of capital also, the equity investment as well as the borrowed funds or the debt investment also. So we are seeing here that because of the inverse behavior, one trend is going down when you are moving from the one level to the next level and from the next level to the next level, and the second curve trend is going up while you are moving from the one level to the other level and other level to the next level. So in this case, a point will come, right? A point will come where both the curves will intersect with each other, and this point is the point of the optimal capital budget, that here at 95 millions of the Indian rupees, if you want to make investment, right? So in that case, if you want to make investment, in that case, your cost of equity capital as well as the borrowed capital is going to coincide with the rate of return. But if you still want to make additional investment, you want to go beyond project C or the investment opportunity C, in that case, what will happen? The rate of return will seriously come down, and the cost of capital normally will remain static, that is 14.6%, but the rate of return expected from the next investment opportunity, that is D, would be significantly lower, and that would be something you call it as maybe a little more than 13.2%, but it is certainly less than 14.6%. And if you further think of making investment into the project 5, that is the project E also, in that case as well, your return is going to seriously fall, where cost of capital is going to remain static at the 14.6%. So up to certain level only. It happens in both the cases. It happens in terms of time also. It happens in terms of the volume of investment also. Up to certain level of investment, you can expect that the required rate of return or expected rate of return from that investment would be more than the cost of capital we are going to invest into the project. But if you increase the investment beyond that level, the expected rate of return will start falling, right? And because you are borrowing more money from the market, which is certainly exhausting your borrowing capacity, so what is happening? This is exposing the borrowers towards a more external risk or towards the financial risk, right? So because of that reason, because the element of risk is going to increase on the firm, or even in case of a standalone project, so the cost of the capital is going to increase, where both the sources, equity as well as debt, are going to charge the higher rate of interest, and as a result of that, the cost of capital goes up. So what is happening in this total structure? One thing, that is a marginal cost of capital, is depicting a rising trend, right? When you are moving from the one level of investment to the other level of investment. On the other hand, the investment opportunity curve is depicting a declining trend, and a point comes where they coincide with each other or intersect each other, and that is the point of the optimal capital budget, because our decision criteria is also same, that your expected rate of return. So expected rate of return from this project is something you call it as a 14.6%, and required rate of return, which is a cost of capital, that is also 14.6%. So at this level, you call it as the optimal capital budget. But if you increase investment beyond this level, so rate of return will fall, cost of capital though remains static, but the difference would be negative. And finally, if you want to go for discounting the cash flows at this cost of capital and the given cash flows which are coming to us on the basis of this investment we are making into the project D and E, so NPV would become negative, and IRR would also be lesser than the cost of capital. So as a result of that, it's a loss-making proposition. So we should not make it as a loss-making proposition. We have to find out that what maximum investment we can make in the market, maybe not in one project, but into the multiple projects, for example. And if they are independent of each other, all the projects can be taken together, and firm has the investment capacity also. Still, it's not the investment capacity, but we have to see the cost of capital also and the expected rate of return available from those investment opportunities, and we have to find out that the expected rate of return available from each of the, say, or maybe the last project we are going to take is, that should be equal to the cost of the capital. So if it is equal to the marginal cost of the capital, then it's fine. But if you increase the investment beyond that, it will become negative. This is one part. Second part, this happens in terms of the time also. As I told you, in terms of the time also it happens. So when you talk about the time component, so in the time also we can say that if you borrow for the, say, 3 years period of time, rate of interest would be some amount, say for example 8%. But if you want to borrow for the longer duration of 5 years or 7 years or 10 years, up to 10 years, maybe the rate of interest can go from 8% to 15%, because the lending source will be involving into more risk taking activity, because they are lending you for the longer period of time and they cannot foresee how your business would behave or respond. So for that purpose, since they are going to take more amount of risk, so because of the term structure of interest rates, longer the duration of the lending or borrowing by the borrower, higher would be the interest rate or the cost of capital. So in both the cases, as I told you, and in case of the investment horizon also, in case of the time period also, the cost of capital keep on increasing, being a marginal cost of capital, being a dynamic cost of capital, it keeps on increasing, and return from the investment opportunities maybe sometimes start declining. So we have to find a point which is a point of intersection, and At that point, your marginal cost of capital as well as the investment opportunity curve will intersect with each other, and that would be the point of the optimum investment for us. For example, in this case, we say it is 95 million, right? This is 95 million. So, up to 95 millions of investment, if you make, then your marginal cost of capital and the investment opportunity curve will be maybe giving you the will be intersecting with each other, we can say, because the rate of return and cost of capital are going to be same at this point, 14.6%, and more than that it will become negative. So for deciding the optimal capital budget, you can take the help of the cost of the capital, and always we have to compare the expected rate of return from any investment opportunity with the marginal cost of capital, and we have to find out that either both are equal to each other, the expected rate of return as well as the marginal cost of capital, or the expected rate of return has to be more than the marginal cost of capital. But if the reverse happens, that the expected rate of return is lesser than the marginal cost of capital, then it's a loss making proposition, and we should not indulge into that kind of investment. We should not make that investment, right? So this is how we can decide the optimal capital budget with the help of the cost of capital or the marginal cost of capital. Now we will discuss the concept of the flotation cost. This is a very, very interesting concept, and many people forget or maybe ignore the flotation cost while working out the total investment requirement of any investment opportunity and the cost of capital associated to that. So we will have to understand it very clearly, what is the flotation cost and on which source of funding the flotation cost has to be paid, because we have largely four sources of the funds commonly available with us. One is the retained earnings, second one is the external equity, third one is the preference capital, fourth one is the borrowed capital or the debt capital. So we have the four sources of the capital normally available to the ventures. Retained earnings may not be available to the new ventures or the standalone ventures because it is going to come up for the first time. So they are going to have the three sources: external equity, or in case of the startups it can be private equity, it can be borrowing, or it can be maybe not, and even the preference capital is also not there in case of the startups. But in case of the existing firms, all the four sources are there. We will discuss it from the standpoint of view of an existing firm, that for example the project is being launched by an existing firm. They also have the retained earnings. They can divert the retained earnings from their own business to the newly being set up project, and they can have the equity capital also, external equity also, preference capital also, and the debt capital also. So in that case, how we can calculate the flotation cost? As far as the startups are concerned, new businesses are concerned, so you can say that the two sources will not be there, and these two sources you can call it as the retained earnings or preference capital. They may not be there. We can have the equity capital also, that is the investment by the promoters or entrepreneurs, and we can have the borrowings also from the venture capitalists or from the angel investors, and angel investors also can give the equity as well. So they can give you the funds in two forms. One is the equity investment, that is a private equity investment, and the say debt investment also, that is a borrowed investment by the project from the angel investor. They can charge the different rate of return on the two sources, but the total investment can come in these two ways. So when you try to understand the concept of the flotation cost, so you can say here, flotation or the issue cost consists of the items like underwriting cost, brokerage expenses, fee of the merchant bankers, and underpricing cost, and so on. Number of things are there. So truly the flotation cost occurs only when you are largely a public limited company, not a private limited company even. If you are a public limited company, or you are being converted from a private limited company to a public limited company, and then you are launching a new investment project or investment option you have, and you want to set up a new project, you want to borrow the funds from the say capital market or through issuing the shares through IPO, in that case the flotation cost will be there on the equity. Sometime in case of the debt component also, when you issue the bonds in the market, you have to pay the flotation cost, and there also the underwriting cost and the brokerage cost kind of the things can be there. So in any case, we have to understand in totality that whether a project is being set up by an existing firm where all the four sources of the capital exist, or if it is being set up as a startup or maybe as a standalone project, if there is a flotation cost, how we have to take care of that, how we have to factor that into the total investment being made in the project, and how we have to say take that particular cost into account. So in this case, we will have to understand here that flotation cost is on account of these different expenses. And when we want to factor the flotation cost, one approach to deal with the flotation cost is to adjust the weighted average cost of capital to reflect the flotation cost. That is the one approach to deal with the flotation cost, is to adjust the weighted average cost of capital to reflect the flotation cost. But there is something wrong in it. What is wrong in that, I will discuss with you. But just you see what you are going to do, if you are going to follow this second point, that you are going to adjust the WSCC. Means, for example, the WSCC without the flotation cost is say 12%. But when you add the flotation cost into it, it becomes something like as 12.6%. So that way you would say that I am adjusting the flotation cost with the weighted average cost of capital, and I am calculating the revised flotation cost. How you can do that? For example, we want to calculate the revised WSCC. So for calculating the revised WSCC, we assume certain things here. That, for example, your cost of a capital, initial cost of capital is say 12%, right? This is 12%, and we have to find out that if you want to float the capital from these different sources, so the flotation cost is going to be 6%. And if you want to factor this into the WSCC and you want to calculate the revised WSCC, so you are going to follow this model. This model is given to us. So if you go for this model, so what will you do here? You will be taking the say weighted average cost of capital. This is basically weighted average cost of capital 12%. So you will be taking this as 12% in the numerator, and you will be doing this, that is 1 minus 0.06, right? So you are going to divide it by this, and if you divide it like this, some value will come, and that value would be the 12.77%, and this value we are going to call it as the revised WACC. Revised weighted average cost of capital, this is 12.77%. But there is everything wrong in it. We should not do like this, and we should not revise the weighted average cost of capital. If you refer to some academic sources like books or some other relevant sources, this approach is explained there that for factoring the flotation cost, you have to revise the weighted average cost of capital, and if you revise the weighted average cost of capital to factor the flotation cost, so this will happen, something like this will happen, and your weighted average cost of capital, weighted cost of capital or weighted average cost of capital will become, that is of the 12% initially, weighted average cost of capital, which is 12% initially, right? This will become 12.77%. This is the weighted average cost of capital, that is 12%. So this 12% will become 12.77% when you add into it the 6% of the flotation cost. Now what is wrong in it? What is incorrect in this method? This method is incorrect because weighted average cost of capital is the annual cost. You are going to pay this cost to the sources of the funding every year on the annual basis, whereas the flotation cost is only one-time cost. Flotation cost you are not going to pay every time, every year. That's only a one-time cost. So if you are going to add a one-time cost into the annual cost, so this estimate is going to be completely incorrect. This is going to be wrong. So what we have to do is, you have to find out some other way. You have to find out some other way for factoring this cost, and that other way is going to be something which we are going to discuss now, that you have to include this flotation cost, not weighted average cost of capital. You have to include this flotation cost in the project cost or the total investment requirement. Total investment requirement of the project. For example, your investment requirement in the project is, say, for example, 200 million, and the flotation cost is going to be, say, for example, 10 million. So your total investment requirement should be 210 million, not 200 million, because out of this 200 million, 10 million will be paid as the flotation cost of the funds from different sources, and only we will be left with the 200 million. So that can be the right way. If you do like this, so what you are committing a blunder, that you are mixing up a one time cost with the annual cost, and this way what will happen, we are going to increase the weighted average cost of capital, and maybe if you compare that weighted average cost of capital with the expected rate of return from the project, so there can be a negative maybe outcome, that somehow because of this, normally your say weighted average cost of capital is 12%, but when you add into this the flotation cost, this becomes the 12.77%, and from the project the expected rate of return is 12%. So despite being a very good opportunity, this will become a rejectable opportunity because the net present value will become negative, and internal rate of return available from the project would be 12%. Your weighted average cost of capital is 12.77%, so you will reject the investment opportunity, right? So because you are doing something incorrect, so you have to do it correctly, you have to do it safely, and for doing it correctly and safely, you will have to find out some other way for factoring the this flotation cost. And in this case, a better approach is to leave the WACC unchanged, to leave the WACC unchanged, and to consider the flotation cost as the part of the project cost or the investment, project cost or investment, right? You have to consider it as a part of the project cost or the investment. If you consider it as the part of the project investment, as I just told you, 200 million is going to be investment and flotation cost is going to be 10 million. So you have to raise from the market not 200 million but 210 million. So that 10 million you can easily pay as the flotation cost and 200 million are left with us to be invested into the project. So that's going to be the right way, because project investment also is a one time investment. Normally we see that when you have been seeing in the cash flow estimation, we have been seeing that if it is not a very rare investment opportunity, in the traditional or conventional investment options, cash outflow only occurs in the beginning of the construction period or maybe during the construction period. After that, subsequent cash outflows seldom happen. So normally we assume that cash outflows are occurring during the construction period, during the zero period, and it's a one-time investment. 200 million is going to be a one-time investment. So similarly, your flotation cost is going to be a one-time cost. So it should be included into the project cost or the total investment in the project, rather than you are including it into the WACC. You are reworking out the WACC and mixing up two different things into one and making out something new, which is not correct, which is not logical but incorrect. So you have not to add up, you have not to follow this. This is the incorrect formula, this is the incorrect method. So you have not to say revise the WACC in any case to calculate the flotation cost, but you have to do something else, and then you have to make it as a one-time cost and add it into the project investment or the total cost of the project. That would be the right way, not this way. So how to add up that flotation cost into the total investment requirement of the project, that I will discuss with you in the clear terms, but in the next class, not now. So we will learn about that, how to find out the flotation cost, how to treat it, and how to add it up in the total investment requirement of the project. Till then, thank you very much.